Satya skills. In this video, let us learn about determination of surrender value in life insurance. In the previous video, you already learned what is surrender value. Surrender value is not equal to total accumulated reserve. That is what you learned in the previous video. The insurer subtracts some expenses and losses from the reserve and pays the balance to the policy holder. This requires some methods of calculation. There are two methods in practice to calculate surrender value. First one is accumulation approach, second one is saving approach. Accumulation approach, net premium is considered for the calculation of surrender value. After surrender of the policy, the insurer need not pay the amount of claims. Therefore, he can pay the accumulated reserve after making deductions to meet expenses. This method considers reserve as the basis of surrender value. The reserve is calculated on gross premium. So, the expenses are to be subtracted from the reserve. The reserve consists of premium paid and interest earned. From this amount, the insurer subtracts overall expenses. Surrender charges. When the policyholder surrenders the policy before the maturity period, the insurer incurs loss due to different types of expenses. Some of such expenses incurred are initial expenses. When the insurer and the policy holder enter into a contract, it involves certain expenses, just like payment of commission to agents, processing expenses, stationery expenses, etc. Usually, initial expenses on an average will be more than the first premium paid by the policy holder. Therefore, the initial expenses are equally distributed over a period of policy. When the policy is surrendered in the middle, the share of expenses on unpaid installments will be a loss to the insurer. Therefore, he deducts some additional expenses to determine the surrender value. Then, it disturbs the financial base of insurer. When many people surrender policies or discontinue policy, it weakens the financial base of insurer. If this happens during depression or recession time, loss will be very heavy. Funds already invested will become a burden, and to meet his regular obligations, he has to liquidate assets. All these directly disturb the long planned financial structure of insurance company. Then it reduces profits. Each policy contributes towards the profits of the insurance company. When policy is surrendered, to that extent profits will be reduced. Thus, it is a loss created by surrender of policy. Another indirect disadvantage we can say is that economic units will be reduced. People who surrender the policy will be healthy and expect longer years of life. Therefore, surrender of a policy reduce long investments and increase average mortality. This results into more losses to the insurer. Expenses to process surrender policy. The insurance company incurs some expenses to process the surrendered policy, which is to be deducted from the surrender value paid to the policy holder. Now, second one is saving approach. If the policy holder continues to hold it and pay premium, the insurer is responsible to pay the claims if they arise at any time. But when the policy is surrendered, the insurer need not pay the sum insured by the policy holder. He is in a position to save something due to non-payment of claims. Thus, he can return surrender value to the policy holder. Like this is a positive point from the insurance company point of view. Under this method, surrender value is paid in lieu of the claim amount, but surrender of the policy curtails future income to the insurer. To that extent, it is a burden to him and also incurs losses at the time of surrender. Surrender value will be paid partly at the time of surrender. At the time of maturity or death of the policy holder, the balance will be paid. It is a common method. Then payment methods. Insurer may pay surrender value in any of the following ways. Surrender value may be paid in the form of cash. This is advantageous to policy holder. Net value of surrender may be used for payment of single premium for purchase of term insurance, and total amount assured will be paid on the event of death of the policy holder. This is not useful to the policy holder. Surrender value may be used for the payment of future premium. Thus, the policy will continue up to a period where the surrender value is adequate to pay the premium. The premium is continued until the surrender value is completely exhausted, and if the policyholder dies, he will get the total amount. The policyholder can purchase annuity by using the surrender value also. Then, following policies cannot be considered for surrender: 2-year temporary assurance, immediate annuity, convertible term assurance, retirement annuity, mortgage redemption assurance, some specific policies during first 5 years. They are not for surrender. Reinstatement of surrendered policies. Surrendered policies can be reinstated within 6 months from the date of surrender, subject to repaying the surrender value paid with interest at 10.5% per annum, compounding half yearly from the date of payment of surrender value, subject to the minimum period of 6 months. Loan interest to be paid up to the last interest due, production of evidence of health. By this, they can again restart the surrendered policy. That's all in this video. All the best.